Hello, I'm Harriet Brown and this is Rebecca Sheldon. We're both from Old Square Tax Chambers, and what we are talking about in this TaxSnax is tax penalties. And the reason we're doing that is slightly topical, Rebecca, isn't it?
Yes, as some of you may have seen, it's been in the news recently. Nadeem Zahawi has had a careless penalty for matters arising out of his tax affairs. So we thought we would talk around why he may have a careless penalty and why it's the quantification that it is.
Yes, and so this, I think, has been reported more widely because Jim Hara has said that penalties are not applied when someone's taken reasonable care. And to be fair to Nadeem Zahawi, I don't think he did say that he'd got a penalty and had taken reasonable care. I think he said that he'd been treated as being careless and not deliberate.
Yes.
And that is a really nice introduction to the sort of three distinctions that penalty legislation tends to draw, and that is between an innocent error, i.e. one where you've taken reasonable care, a careless error, which is one where you haven't done it deliberately but you haven't been sufficiently careful, and a deliberate error.
Yes.
And those are the three main categorisations. So according to The Guardian, Nadeem Zahawi has had to pay tax and then a 30% penalty on that tax. And Rebecca, perhaps you could tell us a little bit about how that 30% works and what it's calculated against, what it's benchmarked against.
So the 30% penalty is, well, I mean, it depends on the category that a penalty is in. So
is it worth saying that before we start that we obviously don't know quite what's gone on here, and so we are making our best assessment of what we think might have gone on from looking at the legislation that was most likely to apply, and we think that it's probable that the legislation that's been applied here is Finance Act 2007 Schedule 24, and that is a regime that deals with penalties for errors. So you put in a tax return, you get it wrong, either you realise and you tell HMRC, and we're going to come on to why telling them rather than being told by them makes a difference. But anyway, there's been an error, and this part of the legislation tells you what sort of a penalty you're going to pay. And I think the press have sort of thrown about this figure of 30%. Now, that figure of 30% is going to be 30% of something called potential lost revenue. And there are some quite complicated provisions to deal with what potential lost revenue actually means. But basically, it's the amount of tax that should have been paid but wouldn't have been paid but for this mistake being found. The complicated provisions tend to sit around things like where it's caused there to be a delay in paying tax, and then that's not quite so straightforward a way of finding it out. But essentially, it's the tax that you should have paid but didn't, and it's a percentage of that. And so in Nadeem Zahawi's case, it looks like it's been fairly straightforward. And so, Rebecca, could you perhaps tell us a little bit about the regime?
Yeah, so the regime in Finance Act 2007 Schedule 24 splits the amount of a penalty based on the category of behaviour. Firstly, so the categories that Harriet's just gone through. So there's careless, deliberate, and deliberate and concealed. And it also is based on the category that a particular issue is going to fall into. So
just to pause there, we've got two different ways of looking at it. The first one is behaviour related.
Yep.
And what counts as deliberate?
Deliberate is where a taxpayer intentionally does something with regards to the error in their taxpayer's document. So they either deliberately put something in that they know is incorrect, or they leave something out that they know should have been in there.
So they know what they're doing. It isn't
Yes.
that they've made a mistake per se. They've got it wrong on purpose.
Yes, they have intentionally done it.
And so what then is deliberate and concealed as opposed to merely deliberate?
So deliberate and concealed is where the taxpayer has done something to go out of their way to hide what they've done. So it may be that they've destroyed a document that might reveal it.
Or a load of used notes under the mattress.
Yes, precisely. Yes, exactly like that.
Okay.
But we're nowhere near that here, are we?
I can't imagine for a moment that we would be, and we're going to come on to why we think we can work out from the penalty that what's been said, that this was careless and not deliberate, must be accurate.
Yes.
And so that's the first way. We've got this behavioural way of dividing the penalties up. We've then got these statutory conditions.
The statutory conditions.
Not conditions. The statutory categories.
Yes. So we have the statutory categories, and I'm just trying to find where they are.
Sorry, we've both got online legislation here.
4A, isn't it?
It's 4A, that's right.
There we go. So, an inaccuracy is in category 1 if it involves a domestic matter or it involves an offshore matter and the territory in question is a category 1 territory, or the tax at stake is a tax other than income tax or capital gains tax.
So domestic matter, that seems like that's probably fairly straightforward.
Yeah, stuff that happens here.
What's an offshore matter?
Which is a lot more interesting as a question.
So in this particular piece of legislation, and I think it should be noted that an offshore matter, there's similar language used elsewhere, for example, in the requirement to correct regime.
Yeah.
And I'm not sure it's identical, but here it's essentially that it involves potential lost revenue charged by reference to income arising from a non-UK source, assets situated or held in a territory outside the UK, activities carried on wholly or mainly outside the UK, or anything having effect as if it were income assets or activities of a kind described above.
Yes.
So offshore essentially covers anything where the tax is charged by reference to something that happens, arises, or belongs outside the UK.
Yes. And
the reason we think this might be important here in relation to our example, which is Nadeem Zahawi, is because as reported, this involves a Gibraltar company or a Gibraltar registered company.
Yes.
Yeah.
And Gibraltar is definitely offshore.
Gibraltar is definitely offshore. So while there's sort of some interesting constitutional matters around Gibraltar's status, for tax purposes, it's definitely a separate tax jurisdiction, and so it counts as offshore here.
And the reason that might be important here is when you look at the percentage. So if it's a category 1 matter, then 30% is the sort of standard number, isn't it? That you,
yes, that's your starting point.
Yeah, your starting point. Whereas if it's a category 2 matter, then the starting point is 45%. And so then that takes us to how we get from 45% to
30%. And we should say those are the starting points for careless errors. The starting points for other errors, for deliberate errors, are much higher.
Yes, much higher. Yes. And even higher again for deliberate and concealed.
And yes, even higher for deliberate and concealed. So we've got, I think, to break it down here, we've got several factors. We've got the behavioural factor first, which determines which sort of penalty sort of bracket we're in. We then add in the category, and that can either aggravate or, I guess, mitigate that starting point. And then we come back to another behaviour-based situation, and this is all about how much you help HMRC in working out the tax.
Yeah, so what we're looking at here is disclosure, and there are 2 different types of disclosure as in broadly in terms of legislation. There's lots of different types of disclosure. But so there's prompted disclosure and there's unprompted disclosure. And so prompted is where HMRC has sort of asked you whether this is a potential issue.
So they might have opened an inquiry, for example.
Whereas an unprompted one is where you yourself perhaps have looked at your tax affairs and thought, hang on, I might have got this wrong, and then spoken to HMRC about it. And the difference between the two is that you are more likely to get more off your penalty if you have an unprompted disclosure than if it was a prompted disclosure.
So yes, so the more help you give HMRC, the lesser the penalty is going to be. But we have those starting points, which are 30% and 45%. And in relation to the situation, as far as we know the facts of it, for Nadeem Zahawi, it looks like one of probably two things has happened, though of course we don't know. And the first is that this is a Category 1 matter with careless behaviour, and he's just been given that starting penalty, so he's not been given any reduction for helping.
Yeah.
And that could be the case because of that slightly curious definition of what an offshore matter is. Because while there is a Gibraltar registered company involved, as far as we can tell, it was managed and controlled here, so it would have been treated as a UK resident company.
Yes.
So it may be that it's possible that this has been treated as a domestic matter and therefore Category 1.
Yeah.
The other alternative is that it is an offshore matter. Gibraltar is a Category 2 territory, and so we've started from a 45% standard penalty, and then there's been some reduction for any assistance that's been given.
Yes.
And I think I'm right in saying that there's sort of like a bracket, isn't there? And HMRC have a limited discretion within that bracket as to how much of a reduction they can give.
Yes.
Do we know anything about what they might look at when they're looking at giving that reduction, or is that a bit more opaque in terms of how we approach it?
So I think within the level of disclosure, they're going to look at, so again, the amount of help that somebody gives, how responsive they are, whether they send everything that they're asked to send, would be relevant to that. Anything else?
Possibly the speed with which people get on with it.
Yeah.
You know, I mean, I think if you drag your heels, they're probably going to be less likely to give you a bigger reduction.
Yeah.
And it's difficult to say. I'm not aware, and that doesn't mean there isn't any, but I'm not aware of any sort of published policy on this at the moment that's particularly current. I think that did used to be, but I'm not aware that that's been updated recently. So it may just be that it turns too much on the individual facts, but HMRC are sort of pinned between two edges of a bracket, I think, aren't they? Is that right, for the different types of disclosure in terms of the discretion? Yeah,
they are. So so it would be under 10A, at least for some types, and if it was for a prompted disclosure and the percentage of the penalty was 30, then you could go down to 15%.
But you might be somewhere between 15 and 30.
But you might be somewhere between 15 and 30, yeah.
And I think and the other thing to say here is, in that way, where you're in that Category 1, on that standard starting point of 30%, if you make unprompted disclosure, the minimum is 0%. You could go down to absolutely nothing for unprompted disclosure. And so it's really, I think what we're saying is it's really important, if you do discover that you've made an error, and it could have been innocent, but it might have been careless, then the sooner you get on it and the sooner that you notify that to HMRC, the better.
Absolutely.
So I think that's about it, really, isn't it? That's a whistle-stop tour through Nadeem Zahawi's penalty as we see it. And of course, we might be completely wrong, but that's our best guess. And we hope that's given you an introduction to how Finance Act 2007 Schedule 24 functions. Thank you for listening.
Thank you.